Thanks, Monique. So today we'll cover these 6 areas to give you a high-level overview of your pension, benefit, and the retirement process. We'll talk about how a defined benefit pension plan works, when you can retire, and how your pension is calculated, and great features of the plan like survivor benefits and indexation. We'll wrap up by highlighting some resources, how to initiate your retirement, and key considerations, and we'll also provide some helpful tips as you plan for your retirement. But let's start first with who is Wise Trust. As most of you know, Wise Trust was created a few years back when the WSIB Employees Pension Plan converted from a single employer-sponsored pension plan to a jointly sponsored pension plan, where the joint sponsors, WSIB and OCU, the Ontario Compensation Employees Union, appointed Wise Trust as the administrator of the plan. Our sole purpose is to administer and provide pensions for more than 10,000 workplace insurance and safety workers in Ontario. The members of our plan include active, deferred, and retired former employees from our 6 participating employers: the WSIB, our 4 health and safety associations, who are the Infrastructure Health and Safety Association, Workplace Safety North, Workplace Safety and Prevention Services, and the Public Services Health and Safety Association, as well as Wise Trust. Wise Trust provides you with the peace of mind knowing that when you decide to retire, you'll have a secure monthly pension for your lifetime. The Wise Trust plan is a defined benefit pension plan that offers security and predictability today and a stable retirement income you can count on for your life, even if you live to be over 100 years old. This means you'll be able to better predict upfront what your monthly pension from the plan will be when you retire, and the longer you're an active contributing member of the plan, the greater your pension benefit will be. You won't have to worry about investment decisions, stock market returns or fluctuations, or base your retirement plans around market performance. And once you retire, you'll receive monthly pension payments for the rest of your life. You'll have the security of knowing that you won't outlive your pension. Plus, our plan also provides survivor and inflation protection. We'll get into the details of those very valuable benefit features later in the presentation. Choosing when to retire is an important decision, and your Wise Trust pension is only one piece of the puzzle. Other sources of income like government benefits, such as Canada Pension Plan or CPP, other retirement savings, and retirement lifestyle choices all need to be considered. The right time to retire will not be the same for everyone. Your unique personal circumstances will help to determine when the right time is for you. And a key first step is taking the time to learn about your pension and the important role it can play in helping you build financial security for your retirement. So let's start by reviewing your retirement options under the plan. You have the flexibility to start receiving your lifetime pension as early as age 55 or as late as age 71 or anywhere in between. The choice is yours. You can retire at age 55, but you can also let your pension grow by continuing to work until you're ready to retire. Different retirement dates can impact your overall pension amount, with factors like your age, eligibility service, and other considerations playing a role. So it's important to understand each of these options. You can retire with an unreduced pension on or after your normal retirement date, which is at age 65, or retire with an unreduced early retirement pension once you've met the plan's eligibility rules, which we often refer to as Factor 85 or 60-20 rule. Or if you haven't yet reached your earliest unreduced retirement date, you can retire with a reduced pension that can start as early as age 55. We'll look at each of these options in more detail. The first day of the month following age 65 is what we refer to as your normal retirement date, which means you're eligible to receive an unreduced lifetime pension that's calculated in accordance with the plan formula. If you want to continue working beyond age 65, your pension will continue to grow until you do retire, or if earlier, to the end of the year in which you turn age 71, when you're required to start your pension, even if you continue working. You can choose to retire earlier than age 65 without any reduction to your lifetime pension if you qualify under one of these early unreduced retirement rules. Factor 85 is when your age, when added to your years of membership or pensionable service, equals at least 85 points. For example, you can retire as early as age 53 if you have 32 years of pensionable service. The 60-20 rule is when you're at least 60 years old and have at least 20 years of membership or pensionable service in the plan. The date at which you first become eligible for an early unreduced pension under the plan is typically referred to as your earliest unreduced retirement date. And you can find that date along with other key dates on your annual statement that you receive every year in June. Similar to your normal retirement date, if you want to continue working beyond your earliest unreduced retirement date, your pension will continue to grow since you'll earn additional pensionable service. If you don't qualify for an unreduced pension under the Factor 85 or the 60-20 rule, you can still retire anytime after age 55. However, your lifetime pension that you've earned to that date will be reduced by 3% for each year that you retire prior to the date you would have qualified for an unreduced early retirement or turned age 65, whichever is earlier. This is to reflect the fact that you're starting your pension earlier and will receive it for a longer period of time. For example, if you retired 2 years prior to your unreduced retirement date, your lifetime pension would be reduced by 6%. That's 2 years at 3% each, which represents 94% of your pension. This reduction is made to reflect the fact that you are receiving your monthly pension payments 2 years earlier. Along with the early retirement options, the pension plan also provides a bridge benefit, inflation protection, and survivor benefits for your loved ones. We'll talk through each of these valuable benefit features, but let's first take a look at how your pension is calculated. There are two main components in the plan's formula used to calculate your lifetime pension: your best average earnings and pensionable service. Your best average earnings is based on your highest average pensionable earnings over any consecutive 60 months or 5-year period during your last 120 months or 10-year period before you retire. Although the best 5 years of earnings are often your last 5 years, that's not always the case. If you decide to take a lower paying job in the years just prior to retirement, your pension would not be negatively impacted. We would use the best average earnings that took place earlier to calculate your pension. Pensionable earnings is essentially your base pay, so it does not include things like overtime pay, job differential pay, pay in lieu of benefits, or performance bonuses. A full listing of what is and is not included in pensionable earnings can be found on our website or in the Wise Trust Pension Guidebook. Your pensionable service is the total years, months, and days of service during which you or your employer on your behalf contribute to the plan, and this can include any eligible periods of service that you purchase or transfer in from another pension plan, periods that you are receiving a short-term or long-term disability benefit from your employer's disability plan, where you or your employer are contributing to the Wise Trust plan for these periods, or periods where you're receiving benefits from a WSIB claim, again, where you're contributing to the Wise Trust plan for that period. If you have part-time service, your pensionable service during that part-time period is calculated as a proportion of the pensionable service that a full-time equivalent employee would earn. But to note, working part-time does not reduce your best average earnings, as we always use the full-time equivalent earnings to calculate your pension. So here's an example of how working part-time affects your pensionable service. Julio here joined the plan on January 1st, 1992, and will be retiring on January 1st, 2026. If he works at 100% full-time ratio, his pensionable years of service at retirement, assuming he doesn't have any breaks in his service, would be about 34 years. If he works part-time at 60% for the same duration, he would have approximately 20 years of pensionable service upon retirement, and again, assuming he has no breaks in his service. You can see here how the service is prorated based on the part-time hours and the effect it has on pensionable years of service. Again, working part-time does not reduce your best average earnings, as we always use the full-time equivalent earnings to calculate your pension. In general, by working and contributing to the plan longer, you get more pensionable service and potentially higher earnings, which increases your overall pension in retirement. Here is how these two components, best average earnings and pensionable service, come together when calculating your pension benefit from the plan. Here is how your lifetime pension is calculated at age 65. It's 2% times your best average earnings times your pensionable years of service minus 0.5% times either your best average earnings or the average YMPE, whichever is less, times your pensionable years of service. This will give you your annual lifetime pension amount that is payable at age 65 or your normal retirement date. If you retire early before age 65, the pension plan also provides you with a benefit called the bridge benefit. This temporary bridge benefit is paid monthly in addition to your lifetime pension from the plan. Your bridge benefit will continue to be paid until age 65 or until you pass away, whichever occurs first. Here is how the bridge benefit and your lifetime pension come together if you retire prior to age 65. You'll receive your lifetime pension upon retirement, plus the bridge benefit if you retire under one of the plan's early retirement options, such as Factor 85 or the 60/20 rule. And here is how it's calculated. It's 0.5% times the lesser of your best average earnings or the average YMPE multiplied by your pensionable years of service. You will notice that this is the same formula used in calculating your lifetime pension as shown in the previous slide. To further illustrate your Wise Trust pension benefits, you'll see here that if you retire early before age 65, you will have two parts to your pension paid from the plan, your lifetime pension and a temporary bridge benefit. Your lifetime pension and the bridge benefit will both start on your early retirement date and will both continue until the first of the month in which you turn 65, which at this point, the bridge benefit stops, but your lifetime pension will continue to be paid for the rest of your life. The bridge benefit helps level your retirement income until age 65 when you can collect an unreduced pension from the Canada Pension Plan. An important thing to note here is that if you decide to take your CPP benefit early, just prior to age 65, the bridge benefit payments from our plan do not stop. There is no impact on your Wise Trust pension, as CPP benefits and pension benefits paid from our plan are completely separate and independent of each other. If you retire after age 65, there is no bridge benefit payable. So let's walk through some examples of how your pension is calculated as per the various retirement factors that we just discussed. Here we have Kaya. She retired on January 1st, 2024 at the age of 65. She had 17 years of pensionable service and her best average earnings are $85,000. The first part of the calculation is 2% times her best average earnings times 17 years of pensionable service, which equals $28,900. We'll then subtract the following calculation. We'll take 0.5% times the average YMPE, which is $68,500, times 17 years of pensionable service, and that will give us $5,823. Next, we'll subtract the two totals to get Kaya's annual lifetime pension grand total of $23,077 at age 65. Here is a calculation example of a member who retired after meeting the Factor 85 requirements, which are your age and pensionable service equaling at least 85 points. Corey reached his Factor 85 date on January 1st, 2024. He was 56 years old and had 29 years of pensionable service, and his best average earnings are $95,000. So again, it's 2% times his best average earnings times 29 years of pensionable service, which equals $55,100. Then we'll subtract the following calculation. We'll take 0.5% times the average YMPE, which is $68,500, times 29 years of pensionable service, and that will give us $9,933. We'll then subtract the two totals to get Corey's annual lifetime pension grand total of $45,167, and this is payable at age 65. But because he is retiring at his Factor 85 date, which is prior to age 65, he will receive two parts to his pension. He'll receive his lifetime pension plus the bridge benefit. The bridge benefit will stop once he reaches age 65. A similar calculation would apply if you qualified for the 60-20 rule, which is at least age 60 and 20 years of pensionable service. Let's now take a look at a scenario where a member retires 2 years before their eligible unreduced retirement date. Rishi is 58 years old and he doesn't qualify for the 60-20 rule until 2 years from his retirement date of January 1st, 2024. This means that his pension was reduced by 6%, which is 2 years at 3% each. Rishi's pension was calculated as follows. As in the previous calculations, we'll need to take the steps to determine his lifetime pension amount. And once we've done that, we need to apply the reduction. Remember, it's 2% per year prior to your earliest unreduced retirement date. So in Rishi's case, he was eligible for the 60-20 rule on January 1, 2026, and he elected to retire 2 years prior to this date, resulting in a 6% reduction. You'll see in the step of this calculation, it's the lifetime pension amount times 94%, which gives us a total of $20,633. And since he is retiring prior to age 65, we'll add back in the bridge benefit amount of $6,850 for a total of $27,483. You'll notice that the reduction only applies to the lifetime portion of the pension. The 6% reduction factor is not applied to the bridge benefit. At age 65, Rishi's bridge benefit in the amount of $6,850 stops, and he will continue to receive his lifetime pension in the amount of $20,000 and $20,633. These examples that we've just shared with you were presented so that you have a better understanding of how your pension is calculated. You don't have to worry about memorizing these formulas. The My Pension Resource online self-service tool will take care of these calculations for you, and we'll show you how later in the presentation. And now that you know the importance of pensionable service in determining the amount of your pension benefit, let's talk about how you may be eligible to get more of it. During your employment, there may be times when you take a leave of absence, like a maternity leave or a leave due to an illness or disability. Or there may have been a time when you've worked for a participating employer, but weren't a member of the plan at that time. As a result, there could be gaps in your pensionable service when you weren't contributing to the plan, and purchasing those eligible employment periods is just another way to increase your overall pension at retirement. So here's a list of some of the more common employment service periods that are eligible for purchase. Periods where you were employed on a temporary contract basis, but not enrolled in the plan. Leaves of absences covered under the Employment Standards Act, like ESA, such as a maternity or parental leave. An unpaid absence due to illness or disability, or an educational or personal leave. an unpaid period due to layoff or strike, and lastly, a period of temporary part-time employment where you were a full-time employee, then became part-time for a temporary period, and immediately returned to full-time employment again. At that point, you're eligible to purchase the portion of service you would have earned had you been full-time during your part-time period. The cost to purchase depends on the type of pensionable service and when you're purchasing it. For certain unpaid leave purchase types, if you initiate the purchase when you return to work within the specified deadlines, the cost to purchase is the contributions you would have made during the leave period. Other purchase types may require you to pay both your contributions and the employer's contributions or the actuarial present value. It's important to note, however, the longer you wait to initiate any purchase, the more expensive the purchase may be. It's also important to note that purchases can only be made while you're an active member of the pension plan. So you'll need to initiate this before you retire or before you end your employment. Once you submit your retirement or leave your employer, the option to purchase pensionable service is no longer available. We'll show you later in the presentation how you can view the periods of service you have available for purchasing, as this is a key feature of My Pension Resource self-service tool. You can also run a pension estimate to see how much the pensionable service purchase would increase your pension in retirement. And if you're interested in making that purchase, you can initiate a quote to get the cost, which will be sent to you within 2 to 4 weeks. Next, we'll talk about some really important key features of the plan, like survivor benefits and indexation. Survivor benefits help provide financial security for your loved ones, whether you pass away, before or after you retire. This benefit is provided to you at no additional cost and is available to your eligible survivors. The type and amount of survivor benefits provided under the pension plan depend on whether you have an eligible spouse, as defined by the plan, or eligible dependent children, and whether you've started receiving your pension when you pass away. First, let's take a look at the definition under the plan for the 3 types of survivor beneficiaries and who qualifies under each. The first is an eligible spouse. Under the plan, this is defined as the person you are married to, or if you're not married, it's the person you have been living with continuously for at least 3 years, or less than 3 years if you're the parents of a child. An eligible spouse takes priority to survivor benefits over any other survivor beneficiary upon a member's death. This means your eligible spouse will automatically receive 66 and 2/3% of your lifetime pension for the rest of their life if you pass away before them. However, if prior to retiring, a member has an eligible spouse that is separate and living apart from the member, and the member passes away, that separated spouse does not have an entitlement to survivor benefits. The second type of survivor beneficiary under the plan is an eligible child. This is where you're a parent of a child who is either under the age of 18 years of age or older, but less than age 25 and attending full-time school, or 18 years or older and has a physical or mental disability that prevents them from earning a living. And the third is a designated beneficiary or more than one beneficiary who may be eligible for benefits under the plan. A beneficiary can be a person such as a child or an organization such as a charity. If you choose to name multiple beneficiaries, any death benefit payable to the beneficiaries will be split as per the allocation on your designation form, or divided equally among your beneficiaries if there is no allocation provided. If you don't designate a beneficiary or your beneficiary passes away before you, any benefits payable when you pass away will go to your estate. That's why it's so important that you review your pension beneficiary designations on a regular basis and update them as necessary to ensure that we have the accurate designations on file for you. It's not necessary to name your spouse as your designated beneficiary since, as we mentioned earlier, under the pension plan, your eligible spouse will automatically receive the survivor benefit. If you don't have an eligible spouse, or your eligible spouse chooses to waive their right to the survivor benefit, and you don't have any eligible dependent children at the time of your passing, your designated beneficiary is next in line for the death benefits. You can view your eligible spouse information and the pension beneficiaries you have on file, as well as obtain the spousal declaration and beneficiary designation form to make changes if or when needed on the My Pension Resource site. We'll show you how later in the presentation. You may be wondering what happens to the pension benefit that you've earned if you pass away before you start your pension. In that event, your eligible spouse will have the option to choose either an immediate or deferred monthly pension, or take a lump sum commuted value of your pension, which can be transferred to their RRSP. If your eligible spouse chooses the immediate or deferred monthly pension, and you also have eligible children, your eligible children may be entitled to each receive a pension up to 10% of your lifetime pension for as long as they remain eligible children. If you do not have an eligible spouse but do have eligible children, your eligible children will receive a monthly pension equal to 66 and 2/3% of the lifetime pension that you earned, divided equally for as long as they remain eligible children. If you don't have an eligible spouse or any eligible children, the value of your pension will be paid directly to your designated beneficiary, or if no beneficiary is designated, the payment will be made to your estate. So what happens if you pass away after you retire and have an eligible spouse or eligible children? As mentioned, your eligible spouse, who is the spouse at the time your pension starts, will automatically receive a spousal pension equal to 66 and 2/3% of the lifetime pension you were receiving, and that percent amount will continue for the rest of their life. If a bridge benefit is being paid to you at that time, the bridge will not continue to your spouse, as bridge benefits are only paid for your lifetime. When you decide to retire, you will be given the option to choose a higher survivor pension to continue to your eligible spouse at either 75% or 100% of your monthly lifetime pension, which will result in a slight reduction in the lifetime pension that you will receive in retirement. This is to reflect the fact that the additional benefit would continue to your spouse in the event of your passing. And just to reiterate, it's your eligible spouse at retirement who remains entitled to the survivor pension that's payable upon your passing, even if you later divorce, separate from your common law spouse, or remarry. If you also have eligible children, they may each receive a pension of up to 10% of your lifetime pension for as long as they remain eligible children, which is at until age 18 or age 25 if they are attending full-time school, or if they have physical or mental disability that has prevented them from earning a living. The amount they receive, if any, does depend on the survivor option chosen at retirement and the number of eligible children. If you don't have an eligible spouse but do have eligible children at the time of your passing, your eligible children will receive a pension equal to 66 and 2/3% of the lifetime pension you were receiving, divided equally among them, and again, for as long as they remain eligible children. If you don't have an eligible spouse or any eligible children, your pension will not continue as it is only paid for your lifetime. However, if the contributions that you made to the plan plus interest are greater than the total pension payment you received in retirement prior to your death, a payment of that excess amount will be made to your beneficiary, or if no beneficiary is named, the payment will be made to your estate. Survivor benefits for a spousal relationship beginning after retirement are not funded by the plan. Therefore, your pension would be actuarially reduced to provide survivor benefits to your post-retirement spouse. You must make an election to add the survivor protection within a 6-month period beginning 1 year after you begin a relationship with your post-retirement spouse. So now I'll pass it over to Marcia to talk about another key feature of the plan, indexation and planning for retirement.
Great, thanks, Nuruja. The term indexation basically refers to the plan's inflation protection, also commonly known as cost of living adjustments. When you retire, the negative impact of inflation on your pension will be partially offset by the plan's inflation protection, which will help your pension retain its purchasing power while the prices of goods and services increase over time. Once you retire, every January 1st, your pension will be inflation adjusted, or rather indexed, based on the formula set out in the plan. Here's the plan's rules or formula for indexation. You'll notice that different indexing rates or rules apply to pension benefits earned up to July 1, 2025, and after that date. When the plan converted to a jointly sponsored pension plan on July 1st, 2020, the plan's indexation rules were updated to provide a new indexation approach for pension benefits earned on and after July 1, 2025, which is 5 years after the conversion date, with the goal of ensuring the long-term sustainability of the plan. For pension benefits earned prior to July 1, 2025, the automatic or the guaranteed indexing rate of 75% of the percentage change in the Consumer Price Index, or the CPI, will continue to be applied to the lifetime pension. Bridge benefits paid up to the age of 65 that were earned prior to July 1, 2025 are not indexed. For pension benefits earned on and after July 1, 2025, the new automatic or the guaranteed indexing rate of 50% of the percentage change in CPI will be applied to both the lifetime pension and the bridge benefit. Additional conditional indexing increases above the automatic or the guaranteed increase up to 100% of the percentage changes in CPI may be granted if the funds permit as determined by the Wise Trust Board of Trustees in accordance with the funding policy. Each year in December, just prior to the January 1st increase, we advise pensioners what the increase will be. And just to further clarify, the indexation plan rules applied to pensions do not depend on when you retire. Rather, it's the indexation rules or rates applied to your pension depend on when you earn your pension, as shown here. Here's a simple example to illustrate that point. Mary has decided to retire on March 1st, 2029. She will have a total of 25 years of pensionable service, which results in a total lifetime pension of $2,500 per month. And since she's retiring before age 65, she will also receive a bridge benefit of $730 per month, and that will be payable up until the age of 65. 21 years of Mary's total 25 years of pensionable service was earned prior to July 1, 2025. The portion of the lifetime pension earned before July 1, 2025 is in the amount of $2,100, and that's based on 21 years of service. And this would automatically continue to be indexed by 75% of the percentage change in CPI each year. But the bridge benefit of $600, also based on 21 years, that would not be indexed under the existing rules. Both the lifetime pension of $400 per month and bridge benefit of $130 per month earned after July 1, 2025, and that's each based on 4 years of pensionable service, would automatically get indexed by 50% of the percentage change in CPI, where additional conditional indexing increases above the 50% up to 100% may be granted as determined by the Wise Trust Board of Trustees in accordance with the funding policy. We just wanted to quickly mention that we understand that we've shared a lot of calculations and detailed information with you so far, And we know it can feel like a lot to absorb all at once, but no worries. To help you process the material at your own pace, we'll be posting the presentation on our website, and you can revisit the content whenever you'd like, ensuring you have the time and resources to fully digest everything. Now that we've covered the key features of the plan, let's talk about some important considerations and resources available to you when planning for retirement and what you need to do when you decide to retire. In addition to all the pension related information you'll find on our website, wisetrust.ca, My Pension Resource is your one stop shop for your personalized pension information and self serve tools that are available for all of our members at any stage of their career, even after retirement. My Pension Resource is easily accessed through our website by clicking on the login button located on the top right corner of the homepage. You can view your personal account, including your address and phone number on file, and your pension spousal information and designated beneficiaries. You can run pension estimates using your own up to date information. You can request a quote to purchase pensionable service, initiate your retirement online, view and download your latest annual pension statement, send and receive secure messages to and from our contact center. You can elect for paperless communication and access and download forms and much more. Once you retire, the site allows you to manage and update your personal account information, including your banking information. If you haven't already done so, here's how you can register for My Pension Resource. It just takes 5 easy steps. Go to wisetrust.ca and click on My Pension Resource in the top corner. Click on the Register Here link just below the login button and enter your ID, your last name, and your date of birth, and follow the instructions to create your username, password, and security questions. For enhanced security protection, you will be asked to provide an email and phone number for multi-factor authentication. And if you have any issues, you can call the Wise Trust Pension Contact Center. Once you've logged into the site, you'll see along the top banner there are 4 main areas: the homepage, My Pension, Messages, and Profile. We'll take some time now to show you how to navigate through the site. Let's start by taking a look at the last icon here on the right, the Profile section. The Profile section is where you can view your personal information that we have on file for you. You will see the date that you were hired with your employer, your plan membership date, and this is the date you became a member of the pension plan, your address and phone number, and your email addresses. The beneficiaries link will take you to the page where you can view your eligible spouse, eligible children, and designated beneficiary information we currently have on file for you. To make updates to any of this information, follow the forms link at the bottom of this page, and it will take you directly to the spousal declaration and beneficiary designation form. Simply complete the form and send it back to the Wise Trust Pension Contact Center. You can upload a copy to the message center in My Pension Resource. However, the original must be mailed to the Wise Trust Pension Contact Center as we require a wet signature to complete the process. You can elect how to receive pension-related material from the Wise Trust Pension Contact Center, and you can do this by visiting the Communication Preferences page. There are 2 options here: receiving the material mailed to your home address, or receiving the material electronically via the message center. And if you click on the messages icon in the banner, this will take you to the message center, which is a great employee self-service feature in My Pension Resource. Here you can communicate electronically with the Wise Trust Pension Contact Center by sending your inquiry directly to them through the secure site by clicking on Create New Message. When you receive a response, you will receive an email prompting you to log in and view the message back here in the message center. And if you've sent messages to the contact center in the past, you will see that the correspondence is all listed here for your reference. Let's move over to the My Pension area. Here you'll see the main self-service functions of the site under My Pension Benefits as shown here on the left side. This is where you can run pension benefit estimates. You can compare different scenarios and save the estimate scenarios that you've run. You can model your retirement income. You can initiate your retirement, and you can view the periods of pensionable service that are available for you to purchase. So let's take a look at how to initiate your retirement. Once you've made the decision to retire and you've advised your employer, you can initiate your own retirement, and it's fast and simple. On the Initiate My Retirement screen, populate your last day of work, and the retirement date will update automatically, which will be the first of the month following your last day of work. Submit your election by clicking the Initiate My Retirement button at the bottom of the screen. This will take you to the next page where you'll be asked to confirm the following information. Confirm the retirement date that you just selected. If you have an eligible spouse or not, and if you do, it'll request their information. Any marriage breakdown information that needs to be disclosed, and your phone number. Click Submit, and the Wise Trust Pension Contact Center will take it from there. You will receive your retirement package in about a month's time. For WSIB members, you will have an additional option to select from, which is Retire with Bridging. You can submit your retirement using this option if you're using credits to bridge you to your retirement date. You'll have the option to either enter in your last day worked, or you'll have the option to enter in your desired retirement date. The system is smart enough to do the bridging calculations based on the leave accrual balances that are received from WSIB. As you can see, initiating your retirement on My Pension Resource is fast, easy, and it's secure. And if you have questions along the way, you can always call the Wise Trust Pension Contact Center. Going back to the My Pension area, you'll find a list of online resources that are available to you under the Resources section here on the right. Here you'll find your last annual pension statement, the pension plan member guidebook, and commonly used forms such as the spousal declaration and beneficiary designation form. You'll also find an FAQ section, which has some great pension information, as well as our contact information. And as you plan for retirement, you'll want to know how much your Wise Trust pension will be. So let's take a closer look at the Estimate My Pension Benefit and Compare scenario functions, where you can get a personalized estimate of what your future pension looks like at any age, retirement date, or key milestone date, and how it can change based on different factors and possibilities, such as retiring earlier or later, or future salary increases. This tool will give you some insight into when you might want to start your pension. And remember that when deciding to retire can impact your pension amounts, so choose your retirement date carefully. You'll see it will also provide some helpful information when deciding which surviving spouse option is right for your personal situation. To estimate your pension, you can choose to input either an age at which you'd like to retire, a specific date, or you have the option to select a quick date. The quick dates refer to your key milestone dates. So that would be your earliest retirement date, your earliest unreduced retirement date, or your normal retirement date. Again, the system is smart enough to figure out your dates for you. You can also enter an annual salary increase rate assumption up to 3% and the date of birth of your eligible spouse to see the surviving spouse options. And if you do have service periods available for purchasing and want to know the impact on your pension if you were to make the purchase, click on Model Purchase of Pensionable Service to select the periods you'd like to include in your pension estimate. You will see in this example that this member has a few periods of service available for purchasing. Visit the Purchase of Pensionable Service screen to initiate a quote for these periods if interested. And once you've entered in all your assumptions and selected the buyback periods to include in your pension estimate, click on the Estimate Pension Benefit button. Here's what the pension estimate results look like. In this estimate, the member has an eligible spouse, so it details the surviving spouse options, also referred to as the joint and survivor options. The estimated monthly lifetime pension amount that you'll receive at the retirement date entered is shown under the column labeled Payable to You. This option provides for the 66 and 2/3 of your lifetime pension to continue to your eligible spouse if you were to pass away before your spouse, where that amount is shown under the spouse column. You can also choose to provide a higher survivor pension to continue at either 75% or 100%. Notice how the pension paid under the Payable to You column is reduced slightly in this example, and this is to pay for the higher 75% or 100% pension amount that would continue to your eligible spouse. As mentioned previously, at the time of retirement, if you have an eligible spouse, you'll need to choose which surviving spouse option is right for you and your spouse based on your own personal circumstances. As you've seen, electing the increased surviving spouse option will result in a slightly lower reduced monthly pension for you, but it will provide your spouse with additional financial security in the event you pass away first. These survivor option reductions are based on both your age and your spouse's age at retirement. And note, the reduction will not be reversed if your spouse passes away first. So when choosing your spousal option, some things to consider would be your age, family history, and health factors. And other things to think about when choosing a survivor option are, will your spouse have sufficient income or savings to manage their current or future living expenses if you pass away first? Does your spouse have their own pension or other sources of income that will last long enough to cover their expenses? Will your spouse rely on your pension as their main source of income? And if so, should you consider the higher 75% or 100% survivor option that won't significantly impact your lifetime pension? It's important to keep these things in mind while planning for retirement, as everyone's personal circumstances are different, and these can be deciding factors in choosing a survivor option. And in this example, you'll see that since the member's retirement date is before age 65, the member is also entitled to receive a bridge benefit paid until age 65 or death if earlier. But notice under the spouse column, the bridge benefit does not continue to the spouse if the member passes away first, since the bridge benefit is payable for the member's lifetime only. You can also choose up to 3 estimate scenarios to do a side-by-side comparison to see the impact of your varied assumptions. For example, you can compare what your pension would be if you retired at your earliest retirement date, your earliest unreduced retirement date, and your normal retirement date to see the difference in your pension. Or you can compare estimates to determine the impact of retiring 1 or 2 years earlier or even later than you originally planned to see the impact of using different salary increase rate assumptions or the difference in your pension when you include a period of pensionable service that you're thinking about purchasing. As you can see, this is a really helpful tool when planning your retirement. Your pension from the plan is considered taxable income, like most other sources of retirement income, like CPP, OAS, RSPs, and registered retirement income funds. We are therefore required to deduct taxes from your pension payment from the plan based on basic federal and provincial income tax table rules. And it's important to keep in mind that when using the pension estimate tool or when viewing any communication from us, the pension amounts displayed are the estimated gross monthly pension amounts, unless noted otherwise, as the required income tax withholding has not yet been deducted. If you'd like to estimate the tax withheld from your pension, you can visit canada.ca and search on Payroll Deduction Calculator, which is a tool that estimates the amount of tax that would be deducted from monthly pensions. When planning for your retirement, we strongly recommend getting qualified, unbiased advice to help with your overall retirement plan. A qualified financial advisor can help you determine how much retirement income you'll need to help you meet your retirement needs and goals. In addition to your Wise Trust pension, consider other sources of income like government benefits, personal retirement savings, or employment income from a part-time job, for example. You may receive CPP retirement benefits and qualify for old age security as well. Consider all your retirement income sources and personal circumstances carefully and obtain estimates before making any decisions. And for more information, such as CPP benefit estimates, please visit canada.ca or visit Service Canada. And don't forget to contact your employer to determine if you're eligible for any post-retirement medical and dental benefits. And if you're not, you may want to consider getting coverage elsewhere. Just a few key reminders that we would like you to take special note of. First, always remember to keep your personal information, such as your mailing address and phone number, updated through your employer. This information is sent to us by your employer to ensure you receive important pension-related information. You can update your personal email directly through My Pension Resource under the profile section of the website that we showed you earlier. Keeping your email updated is especially important as we increase our paperless communication efforts. If in the future you no longer work for one of our participating employers and have a benefit that remains in the plan, it's important that you contact us directly to make any changes to your mailing, phone, or email addresses either through My Pension Resource or by calling the contact center. We can't stress enough how important it is to keep your spousal and beneficiary information up to date at all times. Review your designations on a regular basis and update the information as needed. You can view your current pension designations online under the profile section on My Pension Resource, or you can view it on your annual pension statement that you receive each year in June. It's important to note that these beneficiary designations are strictly for pension purposes and relate to your pension benefits only. They are not related to any life insurance that may be offered through your employer. You'll need to contact the administrators of those benefits to update your designated beneficiaries under those plans. And by keeping your spousal and beneficiary information up to date, you'll ensure that any eligible pension benefits will be distributed according to your wishes. And of course, once you've made that big decision to retire, please remember to also notify your manager. They will receive notification through your respective HR departments once you've initiated your retirement, but we encourage you to have these discussions together beforehand. So now let's talk about how you can initiate your retirement once you're ready. To ensure you receive your first pension payment on time, put forward your request approximately 6 to 9 months before your desired retirement date by either initiating it online through My Pension Resource or by calling the Wise Trust Pension Contact Center. The 6 to 9 months may seem a little excessive, but we ask this as it gives ample time for the contact center to prepare and send you your retirement package, time for you to review, gather the necessary documents, and complete the required forms and ask any questions you may have along the way. You can initiate your retirement, let's say 2 months prior to your retirement date, but keep in mind that you will likely not receive your first pension payment on your elected retirement date. However, once the contact center has everything in order, you will be set up to receive the payments and will be paid retroactively. But do ensure you complete and return all required information within 90 days of receiving the package. Otherwise, we'll assume you've deferred the start date of your pension, and then you'll need to contact us to initiate the start of your pension at a future retirement date. Once you've initiated your retirement, you should receive your retirement package within 1 month. Review the package, and if you have any questions, call the Pension Contact Center. Here are some of the documents and forms that you will be asked to submit along with your completed retirement option election form. Proof of age, this can be a birth certificate, valid passport, or a valid driver's license. Proof of your spouse's age, completed spousal declaration and beneficiary designation form if there is a change required, a completed direct deposit form with a void check. And please note that the plan does not provide direct deposit to bank accounts that are outside of Canada. If you live outside of Canada after retirement, you'll need to make arrangements with your Canadian bank to transfer or wire payments to your account in the country of residence as required. Completing the federal and provincial TD1 personal tax credit return forms allows you to make adjustments to the amount of tax deducted from your Wise Trust pension. You can request that additional tax be taken to avoid owing additional taxes at year end. And since everyone's personal circumstances are different, it is important for you to consider the impact of taxes on your retirement income. So we recommend you consult with a tax advisor or accountant when you file your taxes to learn more about the allowable tax credits and other tax strategies like income splitting between spouses that may be applicable to you. Return all of the completed forms and supporting documentation to the Pension Contact Center no later than 1 month before your scheduled retirement date to avoid any delays in receiving your first pension payment. Though we highly recommend submitting your documents as early as possible. If for some reason there are incomplete forms that have been returned to the contact center or missing documents, the 6 to 9 month time frame that we just discussed also gives time for that type of follow-up. So now we'd like to cover a few important items on what to expect in retirement. Wise Trust pensions are normally paid on the first day of each month. However, if your banking institution does not process payments on weekends or statutory holidays, your monthly pension payment will instead be deposited on the first business day. Contact your banking institution to confirm timing of direct deposits on non-business days. As a retired member, you will receive a pay statement from CIBC Mellon, who is our pension payment service provider, for your first pension payment, which is currently delivered by mail. After that, pay statements will be sent to you only when there's a change to your net payment amount, banking information, or address of residence. It's a good idea to keep your first statement on hand for future reference. And each year in December, just prior to the January 1st indexation increase, we'll advise you of what that increase will be. You'll also receive a tax slip from CIBC Mellon, which is mailed out by the end of February every year to allow you the necessary time for you to file your taxes. Once you've retired, you receive a biennial pension statement from us in June every 2 years. And to update your banking information, visit My Pension Resource or call the Wise Trust Pension Contact Center team. Make sure you receive your pension payment in your new bank account before closing your old one. And to change the amount of income tax withheld, complete the appropriate TD1 forms and send them to the Wise Trust Pension Contact Center as well, either by uploading them to the My Pension resource or by mail. Change is a part of life, even in retirement. So we ask that you keep us informed if you move, if you change your phone number, your mailing address, or email address. When you retire, check to make sure we have your up-to-date personal email on file so that you'll continue to receive important updates from us. And lastly, please remember that the Wise Trust Contact Center should receive any power of attorney documentation or death notifications directly. In closing, if you have any pension-related questions, you can call or send a secure message to our contact center through My Pension resource. The Wise Trust Pension Contact Center can be reached at 1-855-242-1526